How are you reading the reaction, perhaps outsized reaction, to New York Community Bank's results, which certainly surprised everyone because the provision for bad loans was about 10 times what analysts had anticipated, but it is some kind of quantifying of the commercial real estate concerns that have been really lingering in the market for over a year now?
So, first of all, as a community banker, I want to say that New York Community Bank, at over $100 billion in assets, is no longer a community bank. And so this is not something, when you hear community bank, I wouldn't want anybody to think this is an issue with community banks generally. This is a bank that's very large and has just gone over the $100 billion asset level that is giving it a lot closer regulatory scrutiny, and the regulatory scrutiny on banks that size is a lot stronger than it was before the issues that we had earlier this year. So looking at what they have particular, this appears to be not a capital issue per se, but really an issue of loan quality. As you've had downturns in the past and as you've had particularly credit deterioration, there are going to be numerous announcements of this is a very large provision that we're taking, always sort of in the context of we're trying to get everything out of the way at once, and this is all of it.
So how do investors? Oh, I'm sorry, go on.
There's never just one cockroach. So usually when someone says this is all of it, it may not be all of it, but an issue in credit is a bit slower moving than something which is a liquidity issue.
Thank you. That's a really important point. So how do investors discern between something like this, where New York Community Bancorp is saying, which again, not a community bank as you mentioned, saying we're going to be cautious, we're going to write things down, we're going to, account for possibilities that things are going to go bad, versus the kind of quick-moving mark-to-market issues that we had seen in the past that prompted a run on banks?
So one thing, it's a little bit hard to tell because this will be the first credit cycle since FASB changed the accounting for loan loss reserves. So the current accounting is supposed to take account of through the cycle losses, and so it's going to be interesting to see how that actually plays out in this cycle.